Hello and welcome to Talking Stocks. I'm Gugulethu Cele. Now today we're talking global and looking at one of the most recognizable household names in baby care products, Johnson and Johnson. But the group is so much more than just baby care. Here to unpack this stock is Sean Aston as well as Bryan Rudd, both from Anchor Capital. Good to have you as always, gentlemen. Johnson and Johnson's, as obviously mentioned in the intro, one is always associated with the household care products. But it is quite a diversified group, not so, Bryan?
Very much so. The consumer part of it is only a small part of the business, actually roughly about 20% from a revenue perspective, with a big part of it in pharmaceuticals and also medical devices. So very much a diverse business. And
a long-standing history quite clearly here.
Sure, I mean this business has been around since the 1800s and listed since I think during the Second World War, if I'm not mistaken.
So listed back then.
Sure. So it's and they've been growing their dividends and earnings on a quarterly basis for many years. There's a long track record in place for this company.
Let's touch on that track record, especially when we take a look at the metrics. You mentioned the dividend as well as looking at the PE ratio. Is it one that manages to impress?
Yeah, I think the key attraction of a business like this, it's never going to shoot the lights out, right? So you've got a business which is in the top 10 sized globally, so it's a very large company. I think it's not a business that's going to generate 20% earnings growth on a trend basis. They're very large and dominant in many of their markets, so you can expect to see probably high single digit and maybe double digit profit growth over time. But I think with that comes a steadiness with that path. It's a predictable dividend payer that delivers the goods quarter after quarter, and for that you're not having to pay a crazy rating. I think that's the attractive part of this company, is that many FMCG businesses globally that have brand names and established businesses have become quite expensive. And Johnson & Johnson appears to have not actually attracted that ultra high rating. You're talking about a forward probably 15 or 16 PE, so it still appears reasonably valued.
We'll get into the different demographics in a moment, but is it susceptible to the global economic trends that we often see, Bryan, especially when we move into a recessionary period, maybe looking back in 2008, 2009?
This is a business that I think with its varying products that it's got and varying divisions that it sits in, it really has been able to weather a lot of the information. Unfortunately in 2008 all markets came off. They came off as well. But you've got products here that everybody still goes and buys the No Tears baby shampoo for their child. They're still going and they're getting their medication. They're heavily involved in oncology medication. So people are still buying these things. So they have managed to recover from those lows. They are not as cyclical as some of the other ones, which is a very nice thing with this business, is there's this constant track record. There's this consistency to them, as well as consistency in their share price movement.
And a very strong holding I see in developed economies here versus emerging markets, which is quite a small shareholding of where they have exposure to.
Yeah, I mean, emerging markets I think is less than a third of their business. The United States itself is about 47% of their profit, but the vast majority of the remainder is developed markets. So, whilst you're seeing many global businesses, Unilever we might have spoken about recently, has a very large emerging market focus, and that's obviously creating quite a big currency headwind for them right now, given the fact that emerging market currencies are under pressure. And obviously J&J will feel that somewhat less. And the US, I think as a market, is still in pretty good shape. I think what's also quite nice is their pharma business itself appears to be the fastest growing part of their business. Where you look back the last few years, a lot of large global pharma companies had this patent cliff that they were dealing with, where a lot of blockbuster drugs were kind of falling away out of the base in terms of the profitability, and they had to deal with this period of no earnings growth. J&J, certainly their pharma division is actually the fastest growing part of their business right now. Yes. And seems to be quite a research-led organization that continues to bring new products to the market. I think, Bryan, correct me if I'm wrong, it's something like 30 new patents that they've got pending in their pharma business this year. So I think it's a well-established business with a good track record and continues to generate growth. I mean, there's some parts of their business that will be slower than others, but I think that balance provides stability. The fact that you've got devices, you've got pharma, and you've got consumer. At any one point in time, there'll be one of them that's performing quite well.
So clearly that's the investment case then for this particular company, the strong diversification that they have?
Yes, very much so. It's a quality business, strong track record. They've got diversification in the base. You've got your consumer, which we all know is not going to shoot the lights out, but you've got a global reach, growing constantly year after year by a couple of %. Got this pharma business coming in that is the latest and greatest space to be at the moment. We've seen a lot of these companies come to market, ridiculous multiples. Here you're getting exposure to a business in the same categories. They've also got the hepatitis C drugs. They've also got the cancer research and the cancer drugs on a 16 multiple, as opposed to the 30, 40s that we're seeing in other places. And it's there. They keep going. It's a great investment case, great business to be in.
You did touch on Unilever a moment ago, if I'm not mistaken, Sean. How does it compare then to its counterparts and the competitors in the industry overall?
So I think from a valuation perspective, it's quite materially cheaper than Unilever. I think Unilever is about a 420 PE. Yeah. These guys are sitting at 16. This is probably a higher margin business as well, and that largely flows through from the fact that pharma is a much higher margin business. So the overall EBIT margin, I think, is about 28%. Which in itself, high margin businesses tend to provide some stability to earnings because you've got a lot less variability around profit growth when you're sitting with a fatter margin versus a lower margin. And the return on equity is attractive at 23%. So if you can sustain that type of return over time, and you've got a business that retains just more than half of their profits, that math should suggest trend growth of more or less 10% per annum. They've slightly undershot that in recent years. I think the profit growth has been 6 or 8%. But I would say that you're basically banking a 3% dividend yield with anything between 6 and 10% profit growth. And we think the rating doesn't have much risk in it. In other words, it's not too expensive. If anything, it could slightly re-rate. So it's one of those stories where in dollar terms, you should be getting 10% total returns, which is not a bad outcome, I would say.
Brian, if we can come back to you and take a look at the recent highlights here. You did mention that pharmaceuticals is obviously where there's significant growth coming through there, but what about consumers, especially given the opportunities in markets like China?
Very much so. This is one of their key drive areas at the moment is on the consumer, specifically going into the emerging markets where as we've seen, they've got very little exposure to in comparison to developed. China is a key market for them. They're seeing great opportunities in that market. But they're also very cautious in how they approach things, which is also a great quality in a business, that in certain markets, if they need to, they'll take partnerships or joint ventures. They'll bring on a local company to assist them. So they diversify a little bit of their risk, but it is a growth area for them. They continue to drive on the pharmaceutical side. We saw 16% growth last year. We're seeing great pipeline come through for this business. I briefly touched on some of the competitors. They probably released more blockbuster drugs last year than the rest of their competitors did. But because of the size of this business, you don't see as material an impact going through. And then on the medical devices, they've brought in a few new areas. They're seeing good growth out of China. China in medical devices growing in excess of 15% per annum. So they've all got these different divisions. Pharma's the one leading the way at the moment, but they do have opportunities in the other two. And the recent highlights have shown that they're still getting the revenue from those areas.
So the prospects are looking good overall.
Very much so.
We did touch on valuations a moment ago, Sean, but maybe if we can revisit it by taking a look at the trend over the last 5-6 years from 2009. The long-term PE does seem to have spiked up slightly though, but I take it it's a lot cheaper.
I mean, that's not a very long-term graph. That's probably 5 years worth of history, which will include a particularly low period post the financial crisis where it was at a trailing 12 or 13 PE. That's clearly way too cheap for a business like this. So it's re-rated up. It got as high, I think, as a 20 PE. It's back down to kind of, on a forward basis, maybe 15 or 16 or thereabouts, which is certainly well below its peak levels. So we would argue that it certainly represents relative value and even absolute value in a market that's where you're actually paying quite high ratings for companies that are delivering growth.
From a management perspective, everyone probably associates this with the family-run business. Is that a concern for a lot of shareholders?
No, I think the family is still involved. They're not involved to the extent that they used to be. They recently brought in Alex Krokowski as the CEO. They've replaced the chairman a little while ago. And from a CEO perspective, in the 100 plus years this company's been around, this is only the 7th CEO to run this business.
7th CEO.
And it's only the 8th chairman. So they very much sit with a quality management team. There's a quality process around it. And this guy knows he's got the opportunity to prove himself. There is still the family backing there, although they have taken a little bit of a step back more recently. But you've still got the family values that sit within this business.
Well, let's get your perspectives now as to what the experts think of this particular stock. Buy, hold, or sell. Brian, Brian, to start off with you, buy, hold, or sell Johnson & Johnson?
I think this makes up a core variable in any portfolio. I think it's attractively priced. You've got good, predictable, stable growth that's been demonstrated through the years. You've got great opportunities and prospects coming through for this business. So I would add it to a portfolio and buy.
Sean, you agree?
Yeah, I would agree with that. I'd say buy, but in the context of understanding what global markets are likely to deliver you. We're not talking about markets where we think you can get 20% per annum. So that's certainly not the message you want to send out, but a business delivering 10% total returns even would make it onto a buy list in terms of a global index. And I think that's the kind of maths that we would look for in Johnson & Johnson. And on that basis, I would certainly be a buyer.
And you're buying this for the long term?
Sure.
Yes.
At the current prices that it's trading at, obviously you...
Yeah, it's about $100 a share, more or less. So, and that works out at about a forward 15.5 PE, 3% dividend yield. That's attractive.
Attractive at these levels. Brian, you agree, nodding your head,
Yes.
so clearly it's one that you like. And anyone who watches the show would know that you obviously give very good insights on a lot of particular stocks. But that's the view then on Johnson & Johnson for today's show. That's where we leave it. It's a buy, the consensus that we get from both Brian and Sean with regard to Johnson & Johnson. Do join us again next time where we talk more stocks.